I am Matthew Bishop of The Economist and author of Philanthrocapitalism, a book which is very relevant to this theme today, which is really this whole new field of impact investing and how real its potential is to transform maybe many of your portfolios, but also to transform how the capital markets work and to make sure that many of us who maybe had our faith in capitalism's virtues shaken a bit by the events of 2008, can feel that we can be resatisfied that capitalism really is on the side of building a better world for everybody in the long run, which I think ultimately is the mission of impact investing. I have a great panel to discuss this topic with, but before I go to them, I just want to briefly set a bit of context. This is impact investing is a term that's been doing the rounds, as many of you will know, for a few years now. I guess it got a lot of publicity in 2010 when JP Morgan issued a report predicting that maybe $1 trillion of assets could be managed under an impact label, and arguing that impact investing is a new asset class, which unleashed the theologians of capitalism into a completely pointless debate about terminology for the last few years. Discuss. But anyway, since then, this has been more and more on the table. Last summer, when the British were in charge of the G8 meeting, I guess there was still a G8 then, a task force was established to look at, what is it that needs to happen in government policy towards investment, in the practices of investors, of institutional investors, philanthropists, and indeed in the law around corporations and the practice of entrepreneurs and businesses, to really take this concept of impact investing from the drawing board or from relatively small scale projects and make it really big. And I was invited onto that task force just to for full disclosure, to really help write the report that we're going to produce next September. And just briefly about that task force, it has the support of the 7 remaining G8 governments and their active involvement both from the private sector and the public sector. And it has a European Union representation as well. It's also looking at some emerging markets to make sure that this isn't all just about the rich world. And it is divided into a series of national task forces, which I know we have several members of on this panel, who are really setting out to map the ecosystem in their own country for impact investing and to try and propose reforms that could happen to help the class in their own country. And then we have these 5 issue groups, one of which is looking at understanding ecosystems of investment, another is looking at asset allocation and how thinking about asset allocation could evolve to make it easier to have an impact element in it. We're looking at measurement. We're looking at issues around do you need new corporate forms like B Corps and so forth to be a vehicle for investing in. And we're looking at the role that impact investing could play in development, particularly as a sort of alternative way of doing aid that is much more market-based. And I think this report that we're going to produce in September, is going to be a very strong report, and I hope you will all read it when it comes out, not least because it will encourage me to make a good job of writing it when I get down to it. So to know that it's going to have such an important readership. Anyway, with no further ado, I want to turn to this panel and ask each of them briefly. When did you get started? When did this idea that impact mattered, and that you could use your investment activities to secure the kind of social environmental impact that you're interested in? When did this idea first hit you, and when did the light bulb go on? Jean, why don't we start with you?
Sure. Well, my own background is really as a sector jumper. I started with roles in public service and then public sector, and then moved into the private sector and had the great benefit of helping to bring AOL forward. And at AOL, we wouldn't have called ourselves an impact investment, but the big idea there was democratizing access to ideas, information, communication. And then when I retired from AOL 17 years ago, my husband and I formed the Case Foundation, which I've run as chief executive for those years. And I think when we thought about impact investing, how we saw it was really through kind of a big frame, and that was maybe a new way to solve old problems. Because if you actually track a lot of the challenges that are dogging our communities and our societies across the globe, many of them really haven't made progress. And as we think about it, sometimes we recognize there's a public sector role that's very important. There's certainly a nonprofit and philanthropic role that's very important. But to a large degree, business has sat on the sidelines. And what if we could possibly unleash more fully the power of private enterprise, the innovation that an entrepreneurial spirit brings as we look at challenges? So quite simply, we say it's new ways to solve old problems. And the visual I often use is if you can imagine a crew team rowing down a river, but you're missing seats. You can't go as far and you can't go as fast. And those seats that have been missing are entrepreneurs, are great businesses, really taking a look at our social challenges. And what I think is so great about right now is we kind of have tension on both sides, which is working to our benefit as we try to drive momentum in impact investing. We have a new generation that is demanding and thinks and operates very differently than the generations that came before them, empowered by technology to do remarkable things. And we have businesses who know it's not really any longer good enough to just be a force for good through the jobs you bring and the economic vitality you bring to communities. You need to do more. And so I think we see companies like a GE or an IBM using their core products and their core skills to basically address challenges in the world. GE with their Head Health Challenge, IBM with their Smarter Cities. So we see it both as an entrepreneurial opportunity and even as it relates to larger companies, a real chance to look across and say, how can we use what we're really great at that hasn't been applied here to make a big difference?
And was there a particular moment in your own portfolio where you felt, okay, I'm going to do something now that is very consciously an impact investment?
Yes, I mean, Steve and I have been making, what we would consider impact investments for quite some number of years. At the Case Foundation, we recognize there's a huge opportunity to be unleashed here, and we've been fully going to school on it for about 2 years. So we've, and you know this, Matt, because you've been a part of them, we've had hundreds of dialogues with folks all over the map, people who know about it, people who are deeply, were the pioneers that went way before us and are much smarter in this space than we are. And just a full range of people to say, where are we and what does success look like? How can we really unleash this now?
Now, Michael Schlein, I mean, we first met when you were at Citigroup and justifying all these great mergers that took place at that period and Sandy Weil and so forth. And now you run Axion, which is really, one of the leading investors in microfinance, which has become the first distinctive asset class to, or distinctive area where impact has delivered consistent results and returns on investment. I mean, what for you was the moment where you felt you wanted to get involved in this area of impact?
Well, for me personally, before I was at Citi, I spent 12 years in government, both at New York City and the federal government, always where the public sector and the private sector overlap. So I was doing economic development in the New York City government, and I was at the Securities and Exchange Commission in the Clinton years. And then I spent 12 years at Citigroup, where we first met. And I've seen the power of financial services, and just as Jean described, harnessing the capital markets towards making the world a better place. We focus at Axion on the 2.5 billion people who live in poverty and lack access to financial services. Charity, philanthropy is very, very important, but all the philanthropy in the world is insufficient to that task. We have to tap the capital markets, and therefore to do that, we have to provide a market rate of return. That's how you attract capital. So I've been fascinated by these issues for a long time. I was on the board for a couple of years. When my predecessor went into the Obama administration, I was fortunate enough to be asked, and I've never looked back. It's great.
And has it lived up to your expectations so far?
It's an amazing organization, first of all. And again, we grew out of microfinance, which in some ways is, I think of it as impact investing. And it really, we're more than 50 years old, and over that time we've helped to build 63 microfinance institutions in 32 countries that today serve millions. And from an investor perspective, when they're managed well, they can generate 20 to 30% return on equity. And now this new explosion of innovation, frankly based on digital technology and mobile phones, has now given us new tools to reach many more people faster, better, cheaper. So I actually think those returns are likely to continue, at least in the world of financial services.
Now, Tracy, I mean, I guess you work now for social finance, which is very much involved in this whole new area of social impact bonds, pay-for-performance bonds, which I know some people feel could be the next big innovation in public finance that taps the capital markets in a very different way to achieve social ends. Tell me a bit about where your interest in this area came from.
Yeah, it's still very much early in the game. The first social impact bond being launched in Peterborough, UK is still in its 4th year of an 8-year investment life, so it's still very much an experiment. That said, the social impact bond concept has just ignited worldwide interest. You talked about the G7 effort, and very much of that agenda is thinking about how we can bring this innovation to other developed countries. The social impact bond is a recent innovation in the kind of the broader impact investing repertoire, and Axiom being 50 years old, and we're just kind of a 3.5-year-old firm in the United States. And Sir Ronnie Cohen, who chairs the Global Task Force, is also my co-founder bringing social finance to the United States, and my colleague Yaron is here from Social Finance Israel. So it's very much a global vision that we have. At Social Finance, where we're trying to innovate in this new impact investment opportunity in the social impact bond, or pay for success, which is more of the moniker in the United States, is to bring kind of our fiscal challenges in light with our social challenges. So how can we bring several uncommon parties in an arrangement to create financial value and social impact? So the uncommon parties include typically the public sector in the United States at the state level, nonprofit service providers who've been toiling away in the field trying to address social issues, and then the private investor. And let me just take a minute, Matthew, if I may, to illustrate this in a concrete sense. 3 months ago, at the end of 2013, we launched a program in New York State with Governor Cuomo to improve recidivism outcomes and employment outcomes for 2,000 New Yorkers.
So that's 2,000 people in prison coming out into the community.
Exactly. So it all starts with government asking a very important question. How do I want to use this impact investment opportunity to achieve, right? So for Governor Cuomo, his policy priorities was to improve employment and reduce recidivism for these 2,000 folks exiting state prisons. And with that, we went out into the field and found the best nonprofits, kind of do your classic due diligence that a venture capital firm might do. Look at the track record of the nonprofit provider, look at whether their past evidence has produced results, look at the management team, their governance structure, and ultimately settled on one provider with a 35-year track record of year in, year out serving these very difficult populations. With that in mind, we then partnered with Bank of America to create a private placement, actually the first private placement in kind of the broader impact investing field, to offer this security, which is a Reg D security, to the high net worth clients on their platform. So we raised $13.5 million from around 45 investors, including the former Treasury Secretary Larry Summers and a couple of other investors who've chosen to go public, such as the Arnold Foundation, the Sorensen Foundation, and the Pershing Square Foundation, to raise this capital to fund the expansion of this nonprofit's work to serve 2,000 additional New Yorkers. And if we're able to reduce recidivism of these 2,000 folks vis-a-vis a control group which do not get such services, by 8% reduction in recidivism, New York State realizes correction savings and other public assistance savings, and they will repay the investors in the form of principal repayment and up to a 12% per annum return if we achieve the results that we set forth to achieve. So it's really, really exciting. What's most exciting, I think, intellectually and conceptually for us is that it's the very betterment of lives that's providing the investment alpha. It's the person getting a job, keeping a job, staying out of trouble. That is the source of investment returns vis-a-vis government savings. And the other thing which I think has ignited the imagination of the capital markets, you said that earlier on, Matthew, in your opening remarks, is that unlike in 2008 when you released your book, Philanthrocapitalism, when the aftermath of the next few years with the great financial crisis was that we used kind of private dollars to bail out some, public dollars to bail out some large financial institutions. What's really captured people's imaginations around the social impact bond, and it flips that whole paradigm on its head. Here we're asking private investors to privatize that risk, and when we achieve public good, those gains are broadly socialized. So it's still early days, but we're doing a lot in the area of managing health outcomes, funding early education programs, serving the elderly in poverty better. Any place where you can invest $1 of prevention today to save many more dollars of treating the problem downstream is an appropriate application.
Great. It seems to me that probably Asia has been most open of all parts of the world to embracing this idea of impact investing. Can you just tell us a bit about how you, I guess, left the safe capitalistic highlands of Goldman Sachs to sort of throw yourself into this area?
Sure, Matthew. Well, good morning, everyone. So just by way of background, I work for LGT Venture Philanthropy. We're a global impact investor initiated by the princely family of Liechtenstein in 2007. We support over sort of 30 portfolio organizations globally across areas of healthcare, education, agriculture, and renewable energy. So we've been doing this for a while now in a relatively nascent space of maybe a decade or so. We've been doing it for for 7 years. So coming to Asia, I think if we look at our portfolio, we have 17 organizations in Asia. So a concept which is synonymously sort of known to be created in the West is getting quite a lot of traction in Asia, and through our own portfolio, you can see that happening. Quite often when you speak to impact investors, you hear sort of several challenges, and one of the challenges that they have is trying to find investable quality deal flow. And on the other side of the spectrum, you often see people that say that there's not enough money flowing to the space. So it's a perennial argument. But
what got you interested in it?
Well, I think like myself, I think I would say many of the younger generation, if I may. Not that young anymore, I'm Asian, so I'm actually 65. But jokes aside, there is a new breed of Asian leadership. Asia is in a phenomenal place in the moment because it's the greatest intersection of the biggest wealth accumulation together with the greatest need. So naturally, in a place like Asia where things are driven by families, you find that the new breed of leadership are aware of this and they want to sort of make that connection. So quite often, a lot of people driving this impact investing space are people like myself that spend time in traditional industries and now saying, hey, let's sort of align what we feel personally with what we do professionally. So they've come into this space either as social entrepreneurs or impact investors, and that's a bit of the motivation. And if I can add to that, Prince Max, who is the founder of LGT Venture Philanthropy, he himself came from sort of 11 years in private equity. So when he was asked to sort of do his family philanthropy, he thought, why can't I use some of these proven processes in venture capital and private equity? Why can't I insert greater transparency, efficiency, and accountability to creating social outcomes? So that's really the genesis of how we were created, and so that sort of aligns with myself and my whole team.
Now, as we prepared for this panel, very much we got the message from the Milken Institute organizers that the people now, there's enough talk about impact investing. It's been around for a few years. It's very much in the air. Lots of people have said, yeah, I like the idea in principle. But fundamentally, there's this sense that it's still regarded as a bit nice and not really transformational to the capital markets as a whole, that it's a kind of little plaything of a few people, but not a big deal. I really wanted to push each of you on, what really is the potential of this, and how quickly can it be taken out of the nice box and put into the serious investing box, and B, the serious impact box? Jean, I'll start with you.
So I actually think it's a little of both. I think we're super, super early days. And we were just talking this morning at breakfast with a group around the table. You know, sometimes when you stand in the forest, you can't really see the progress you're making. And the story I like to tell is a very recent one, even just from last week. In our work around this G8 Task Force and Advisory Board, we were in New York City last week doing something kind of special, but it starts 15 months ago when my husband Steve and I were doing kind of a fireside chat at the New York Stock Exchange with their CEO. And he said, "This impact investing, have I been living under a rock? Tell me about that." And of course, we were really reminded that we are early days if the CEO of the New York Stock Exchange didn't know what impact investing was. Fast forward the tape 15 months, and we stood on the balcony, didn't we, Tracy? It was a lot of fun at the closing bell last week at the New York Stock Exchange, celebrating impact investing. And so we are starting to see institutions and individuals and, you know, some of the frameworks out there changing. But we really still are so early days, and so much of the ecosystem is missing still. But that's okay, because, you know, I am a student of history, and if I look back at where venture capital was at this point in its march, you know, it didn't look all that dissimilar from where we are today, and it didn't take much for that sort of hockey stick to happen. And that's probably going to happen here. We're going to have a tipping point, but are we, you know, far away? We are. And we have our critics, and we talk about this. Warren Buffett, you know, he says, beware of impact investing. And Mark Andreessen had a very famous line at a Forbes gathering where he said, you know, impact investing is like a houseboat. It's not a good house, and it's not a good boat. But I was teaching a class at Yale's Business School last week, and a student, and I show that clip when I teach students about it, and one of the students said, well, I kind of think about impact investing like brunch. It's better than breakfast, and it's better than lunch. And so, you know, it's not surprising to me that that's sort of one generation responding to how another generation looks at it. So, you know, I think it's coming together, and I think there's more progress than we realize, but we still have a long way to go.
I mean, I guess you hit on one of the issues, which is that people, I think a lot of people assume that if it's got anything other than investing in the name, then essentially it's about charity, it's about below market returns and so forth.
But you look at a company like Revolution Foods, which is actually out here in California, and I see some heads nodding. You know, it is a terrific impact investing company, as was Tesla as well. But at Revolution Foods, they're serving 1 million healthy foods a week. And we talked to Kristen last week, the co-CEO. And they're, you know, what they're doing is they are passionately focused on building a viable business. And the early investors will feel great, I'm sure, as they see the financial return. But what they'll really feel great about is the social impact that they use their capital to have. And so we're just seeing exciting opportunities all over the market where entrepreneurs are bringing that spirit and having access to capital, you know, that can take them far. We still need lots more on-ramps. We need more on-ramps for investors so they know where to go, as you were saying, and have, you know, some tools to make them comfortable. And those deal flow opportunities that are out there, they need paths to this capital as well. And I think crowdfunding will probably be pretty powerful in that front.
Tracy, I mean, we talked about the social impact bond. Very early days again, but how big a deal do you think it could be, and what needs to happen to materially affect, you know, the finances of a fundraising of a government like the United States or indeed smaller countries?
The potential is massive. If you just take one vertical around correction spend, basically what social impact bond is trying to do is monetize recoverable future government savings, right? So if you just take the criminal justice vertical, this country spends $70 billion on incarceration every single year at the federal and state and local levels, over 2 million people behind bars. Now, not everyone should be part of these rehabilitation programs, but for those who could, that's in itself a multi-billion-dollar market. Look at you know, management of chronic illnesses. We just kicked off a project last year in Fresno where we're going into the homes of asthma-afflicted patients. So right now, if you're a low-income child suffering from asthma and you go to your primary care physician, all you get is an inhaler, essentially, when we know over time and again from medical research that it's the environment that causes the environmental triggers that gets the kid into the ER in the hospital. So we're going to the homes of 200 families to do home retrofits, take out the mold, remove the carpet, put in hypoallergenic pillows, and begin to track the pre and post healthcare utilization through claims data to look at what kind of impact this intervention has had on the patient, and then scale up to a real financing. So all these different verticals, and then you think about the needs of veterans around workforce development issues. You think about the elderly aging and keeping them healthy in their communities longer before you ship them off to nursing facilities. All of these represents massive, from a financial perspective, opportunity. That said, the power of social impact bonds isn't really just about the money and kind of getting the capital markets to fund this prevention, take on the risk so the government can pay off the back end. It's also about getting everyone together to act in a coordinated way so that you can actually generate social value. Jean talked about the analogy of the rowing team, the oarsmen in the boat. I think a lot of the characters are actually sitting in the seats, but their oars are completely locked. The government would be funding a program here in affordable housing, yet it's not well coordinated by the nonprofits who are deploying the capital and serving the people on the ground. If we can get better policy to get everyone's oars unlocked and rowing in the same direction, the velocity, if you will, could even be accelerated. It really is an exciting moment, and we have a lot to learn from these experiments, but tremendous promise. But
do you see, because it's interesting, if you talk to traditional Treasury economists, they will say, we can borrow more cheaply than anyone else on the planet. So why would we want to go down the route of putting a whole load of our spending out to higher risk, higher priced borrowing, which is essentially what the social impact bond is.
Right, so the risk premium is actually the risk transfer, because government does not pay until results are achieved. So in fact, with one word, a price at option of being able to get someone to take on the risk, these are actually not, it's quite thinly priced options. It's actually a great deal for government. They only pay for success, and it's a great line for achieving a taxpayer accountability. So from a Treasury perspective, in the out years, if we could get social impact bonds to prove to government that it's actually better policy for them to invest directly in these preventative programs, that would be great. Our mission is to work ourselves out of a job. And if they could directly fund these programs, it's definitely a cheaper cost of capital.
Now, Michael, I guess a few years ago, microcredit, microfinance was all the rage. It was lots of people giving to it philanthropically, people investing in it as an asset class. And we had the SKS Finance IPO in India, which was including some sort of serious venture capital firms from the Valley were in that deal. And then it all seemed to go a bit pear-shaped, particularly in India, where you were getting people who were overborrowed and farmers committing suicide and so forth, and the SKS got into some regulatory difficulties. And now I feel like microfinance is still struggling a bit to recover its fashionability. And so, what are you learning from what's happened in that part of impact investing as to where impact investing might go in future and what needs to be avoided?
There's a whole lot of rich parts to that question. But let me take one step back before talking about SKS and the crisis in Andhra Pradesh. You were asking about, is this early days? Is this a real investable field? I want to put it in perspective. 1992 in microfinance was an enormous watershed. Before that moment, all of microfinance around the world, which only really started in the 70s, was done by nonprofits. In Bolivia, Accion created the first in the world for-profit bank for the poor. Of course, then it could access the debt markets, the equity markets. It attracted talent in a different way. It was regulated a different way. Later, it could take deposits. And Banco Sol in Bolivia was doing very well, and it took off. And then much of the industry followed that model, and then all of a sudden, fueled by the capital markets, much of microfinance. When you think of microfinance, you think of mostly the 20 years, and it's because of what happened in Bolivia in 1992. Now, 20 years later, billions of dollars have been raised to be invested, and it has become an investable class. So I think that's a fair time frame of how long does this take to build the whole ecosystem you need. But of course, we all know that the pace of change is changing. So I saw a chart the other day that showed the adoption of computers, the adoption of radio, the adoption of TV versus the adoption of the internet and cell phones. And the pace of change is just radically accelerating. So I do think that 20 years is some reasonable time frame, but I think we can do better. So that's the first part of it. I do think, that said, the industry has grown in 20 years from serving, tens of thousands of people to 200 million people around the world. And I think SKS and Andhra Pradesh were really growing pains in an industry that has grown very rapidly. I do think there were all sorts of problems. I could spend an hour just talking about Andhra Pradesh, but I won't. But to be fair, there were real issues of overlending, over-indebtedness, bad collection practices, a lack of transparency, poor regulation. And it was fueled, in part, people say it was fueled by the desire to have an IPO, and so they were sort of growing as fast as they could. And it was also an abdication on the part of the regulators. The Reserve Bank of India, one of the best regulators in the world until recently, said that's not our job. And now they've taken on the mantle of regulating, and they're doing an amazing job. But back when the SKS crisis happened, there was no real adult regulator. In fact, the Andhra Pradesh government was an actor, not a regulator. They were in this market providing state-owned, so elected officials providing, controlling state-owned banks that were providing subsidized loans to the poor. It's not hard to see what could go wrong with that. Anyway. I do think the industry has come together in ways that it never did before to sort of address those growing pains. So I think specifically as an industry, groups that used to hate one another are now working together. There's something called the Microfinance CEO Working Group that brings together CEOs of Axion, Grameen, Women's World Banking, like 9 or 10 of the largest global networks. And they're committed to an agenda around consumer protection, transparency, and developing a uniform way of measuring social performance. And if you think that the challenges are over-lending and over-indebtedness, you can see where consumer protection and pricing transparency are critical to the future.
So there's this sense that I alluded to, that somehow microfinance has become less sexy, just at the moment, in a way that you're kind of sorting out the problems. You've proved the track record. It is ready potentially to take off as an asset class. So what do you see happening in the next 2 or 3 years, and how much could it scale up from here? Is there just a huge potential investment there, or is it actually right that people are kind of looking elsewhere a bit now?
Well, in fact, I think these are all related. I think the growing pains and the speed bumps and the issues that we have to grapple with, I think as we grapple with them, then we can sort of take the next leap to the next level. Plus, I do think we tend to talk about microfinance a little bit differently than impact investing. It's really a continuum. This is all about financial inclusion for the poor. And think of microfinance as the branch banking for the poor. And just like in your own life, there's many, many other ways of meeting the financial services needs of the poor. So I think you're right. Microfinance was way overhyped. Mohammed Yunus won the Nobel Prize. The UN created the Year of Microfinance. There was a lot of excitement. And now I think the new hype, I worry a little bit about impact investing. Is that going to solve the world, or social impact bonds? I think the reality is we need to find ways of harnessing the capital markets to improve the world, and we need to be patient about it. I think these are early days. I think the impact investment equity funds, I don't think there are too many that are over 150 million today. So it's early days in this industry.
So if we switch to Asia, I mean, where are you seeing the opportunity for dramatic change, and that takes it out of being just a sort of nice thing into being a transformational thing?
Sure. I think there's several impediments, as I mentioned earlier, and just to your earlier point, Matthew, about returns, right? I mean, by and large, for impact investments, majority of what we're talking about are private equity or venture capital direct investments. And this whole question of returns really relates to the fact that the industry is nascent. So we don't have enough examples of realized exits. And that's really one of the drivers of not having enough track record in this space. I think that if you look at India as a proxy for Asia, there have been some track records. There are many companies that we've invested in that are now scaling up to the Series B, to the Series C. So we're starting to see positive signs even on the private equity deal front. Now, if you look at the macro environment and the enabling infrastructure that we all talk about, there are various initiatives in Asia, both on the funding side as well as the demand side. On the demand side, you've got everything from incubators, accelerators, business programs now that train and groom and capacity build social entrepreneurs. That's all happening. In a modern metropolis like Singapore, I can name you 10 in the last 5 years. And that's happening across Asia, right? But on the other side is also quite positive as well. If you look at the funding side, whether or not it's investor networks, it's deal facilitation platforms or intermediations, it's starting to happen. So that's how industry slowly creates. Now, if you look at the level above that, government and policy, it's interesting that a year ago the Hong Kong government put together a $500 million fund, Hong Kong 500 million, so it's about 70 million US, specifically to promote social entrepreneurship in Hong Kong. Korean government, the Seoul metropolitan government, put together a $100 million fund. So you're starting to see these sort of positive signs, right?
Is that actually backing social entrepreneurs with a goal of making a return on that investment, or is that pure philanthropy?
So they're slightly different. So the Korean one is to back all Korean social enterprises, some of whom are set up as non-profit. So question whether you can get a revenue stream from that. But by and large, a lot of them are trying to become financially sustainable businesses, right? The Hong Kong government is slightly different. It's investing in the infrastructure. It's investing in 10 intermediaries to help provide innovative programs and capacity build. So not really at the next stage yet. We're trying to invest directly in the social enterprise. But what I'm saying is that the fact that you see government playing such a proactive role is a very positive sign in the industry. How soon that industry will turn, we don't know. But it is a very positive sign. And obviously, with the concept of social impact bonds, Singapore, I was recently in London with a delegation of Singapore government ministries, etc., looking into financial innovation along these lines. So these are all good signs.
Yeah,
go ahead.
Tracy.
That's my hometown, Hong Kong, Asia. I grew up there. My whole family's still there. I became a naturalized American, as they say, through marriage. So that sentiment completely resonates with me. The bifurcated view of making all your money and then kind of doing good in the world through philanthropy is because of the tax code, and hence we have such a thriving philanthropic marketplace in the United States, is very much an American phenomenon. The idea that you can complement your charity work, your philanthropy, with other tools that may not be a market rate return instrument, but at least returns your principal and maybe some return, is very attractive to the Asian mindset. And then the other thing that is even outside of the Asians that resonated with a lot of our American investors in our deal is the lack of correlation for social impact bonds. The underlying asset is whether these nonprofits could actually deliver outcomes to make people's lives better, because that's the source of alpha. Is nothing to, correlated with the stock market, with interest rate, and in a zero interest rate environment where folks are looking for lack of correlation, it's been attractive.
So if we talk about track record, what would each of you maybe come up with one sort of signature investment that you see that really captures the potential that you've been involved in? Maybe we start with Eugene.
Sure, and before I do that, I'd just like to underscore what Tracy said, because being the philanthropist and investor sitting on the stage, I think it's a little bit of a false choice that we see in America, right? And this is where the globe is a little ahead of us, or other markets outside the United States are ahead of us. Because, what I'm engaged in every day is 100% loss of capital. That's what philanthropy is. It's 100% loss of capital. Now, we're swinging over here debating, is it market rate return? Is it better than market rate return? There is really a lot of space to play between 100% loss of capital and market rate return. And we're crazy in this country if we don't find ways to develop those tools. And when I talk to other philanthropists about using even some of their foundation grants towards what are called PRIs, which is a way you can actually do impact investing with your grants, it's amazing to me that I've heard them say, well, that just feels risky to me. And I say, okay, but your alternative is 100% capital loss. How can there be more risk than that? And so I do think, some of the silos, the way we've developed in our society around our thinking around what drives good in our communities, has to change. And of course, most of these foundations, we're living donors, but most of these foundations were started by great entrepreneurs, right? Who understood how to use business to drive change and scale and all kinds of things. And so I think it's just getting back more to the roots of what started philanthropy in the first place. So I almost see it like a full circle thing. In terms of stuff we've done,
Yeah, a deal that shows us it's not just about giving money away.
Yeah. So we helped start and fund something called the Brain Trust Fund. And this came out of our work in brain cancer, where we actually have a brain cancer initiative called Accelerate Brain Cancer Cure. And we realized that there was a real gap in the marketplace. There were a lot of really great ideas, but there wasn't necessarily capital that was willing to deploy because of the risks involved. Brain cancer is very, very thorny, perhaps among the most thorny of all cancers. And so we kind of scratched our heads and said, gee, what could we do? As we talked about some of the people who are deeply engaged in philanthropy, again, going back to that 100% capital loss, we said, well, what if we provided a fund that would go out there and find the most interesting opportunities to begin to address challenges in brain disease? Would you be interested in investing? It was actually, we were really thinking, we're just not sure we're going to test the waters. It was an easy sell to people who were already in it philanthropically, because they saw it as yet another on-ramp, another channel that they could use.
And these were for-profit opportunities, right?
Yes, all for-profit. It's a for-profit fund and did exceedingly well with its first exit. So, I think those kind of things.
What was the first exit?
It was a company engaged in, it's kind of complicated, but around fluid in the spine, and sort of regenerating that as part of brain health. But the point is that I think we're going to see lots of new structures come out that just we aren't used to today, that ride either side by side with philanthropy or side by side with the public sector spending, or in a perfect world, both.
Ed?
Absolutely. So I'd like to second Jean's point about this whole question of trade-off. I know quite often panels like this always talk about trade-off. And we are essentially backed by a family, so we tend to work with a lot of families. So when you find that, the broad spectrum of impact investors can range from high net worth families all the way to institutions and funds. And principally when you're dealing with your own money, you have the right to dictate what that trade-off is. And for many families or high net worth individuals that may start from a more philanthropic basis, they come to this space and say, wow, that's no trade-off for me, because I see it as an improvement from my minus 100% financial loss with, sort of more certain outcomes, transparency and reporting. And most importantly, with the upside of return and possibly scale. So that's a huge gain. So I think it depends who you ask the question to, and particularly in our space where we tend to be backed by a family that believes that and work with other families and co-invest on that basis, it's a much easier sell. Right. To the second question, I think, Matthew, about one of our success stories. I think there are a few success stories, but I'd like to share this one because it's in Asia and something that I feel passionate about. It's a company known as Husk Power Systems. I think some of you might have heard about this company. So I'm going to talk a little bit about its genesis and its legacy, just to explain a little bit of this dilemma that we face. So when Husk Power Systems was a company in India that tried to use rice husks to provide affordable electricity. So when they were a pretty new startup, they tried to go to foundations and ask for money. And foundations looked at them and said, no, we can't give you money for R&D, right? We give the money if you give it away. Then they said, go to your clean tech investors. So they went to clean tech investors and said, oh, we like the idea, we like the model, we like Bihar, we like India, you see the scale, but you're not far enough along, you don't generate revenue. So how could we invest in you? So this is a typical example that many social enterprises face. So they came to venture philanthropists or impact investors like us. Together with Acumen and Shell Foundation, we invested in the first round, to which they used the money to build the R&D to build these rice husk gasifiers. So if any of you know, Bihar is one of the poorest states in India, but it also happens to be the rice belt. So you've got many, many rural farmers have no access to electricity, but have plenty of rice husks, which can be biomass fuel to generate into electricity. And that's exactly what we did. We seeded them to create these gasifiers. They became revenue positive and started selling these gasifiers. And in less than sort of 4 years, we power 50,000 homes in rural Bihar. And if you ever see Bihar, it's the kind of place that you drive after sort of 6 p.m. and it's pitch dark. And now you can see sprinklings of light everywhere. So that's the kind of scale that you could have. If I turn back the clock and said, if I'd given the same amount of money as a charity or a grant, could I have got this amount of scale? Possibly not. I don't think so, right? So that's one example.
And what was the exit?
They haven't exited yet. So we just closed the 5. So we went in a couple 100,000, a small deal. But last year we closed a $5 million round with some other investors. So we don't know the exit
And what
yet.
kind of return are you hoping for out of that?
Well, I mean, it's an equity investment, so we would say sort of high teens, realistically, based on our model. And all this it's unrealized, but we're modeling it out. And I think it has huge scale. It can scale within, obviously, in India. It can go to Africa now. It has, I mean, potential exits could be, you could be bought out by a company that wants to power electricity in rural Bihar. You know, it could be bought out by the national grid. There are plenty of strategies going forward. All I'm saying is that as an immediate sort of stop check, health check against our success, I think that's a pretty successful scaled investment, which is one of the drivers driving impact investment. And nothing wrong with charity, but I'm saying we're trying to use impact investment as a way to get to sustainable and scalable results.
Michael.
And this is one example.
So in the world of microfinance, there have been 2 IPOs, one Cabartamos in Mexico and the other one SKS in India, and both the initial equity investors, including Axion, in Cabartamos made significant returns. And those, to some degree, are a little bit of lightning strikes. I don't know that that's replicable, but much more realistic and sustainable is we created a dozen years ago the Axion Investment Fund and raised private capital along with our own to build microfinance institutions from Bolivia to Peru to Nigeria over 10 years. At the end of the 10-year fund, we realized a 15.6% annual rate of return over the decade, which is terrific. And again, think of where we're operating. We were also in Ecuador and Venezuela, and we're in some difficult markets, Lagos, Nigeria. And not only did the investors realize a significant return, but we've built, for example, the #1 microfinance bank in Nigeria today was built with the support of this fund. So fast forward, we'd love to do the exact same thing in the new world of impact investing, and that's what we're trying to do. Tracy?
Yeah, I'll give a story not about social impact bonds, but to your earlier point, Matthew, that the debate whether impact investing is an asset class or whether they're impact investing opportunities in all the asset classes, and I think there's broad agreement. Jean, this is a heavily debated topic on our
violent agreement on this point.
Exactly, violent agreement that it's more of an investment philosophy and approach, that there are such opportunities embedded in all the asset classes. And I think it's, while it's very important to think about using more flexible capital like that of family offices and high net worth individuals where their investment mandates are much more flexible to pioneer some of these things. The hope is very much to tap into more commercial sources of capital over time, because that's where the trillions of dollars of institutional capital can be unleashed. And I think that's where philanthropy and government can play a very important role. And I'll highlight one example from the New York City Acquisition Fund, which is an affordable housing initiative several years ago, where several foundations got together with the city and provided credit enhancement vehicles so that they could basically mitigate some of the risks in order for the major banks to come in to deploy their loan capital in a fully kind of commercial manner. And the layering structure and the coordination of different entities to come together in a way where the commercial lenders can see a risk-adjusted rate of return and make this commercially viable for their lenders to put up this money, but using government capital and philanthropic capital to mitigate that risk and make it easier for commercial money to come in. I think it's a structure that we are very excited about, and we hope that could be replicated in other areas, and also very much a anchor point in our report that will be coming out in June to encourage the federal government to use the capital in a way that would be catalytic for commercial capital to come in.
Yeah, I think that's really powerful. And, we have seen the institutions move. We talked about JP Morgan's fund. Last week, I was with Goldman Sachs investors in their new impact fund. Carlyle doesn't call it an impact fund, but they came out with a sub-Saharan focused fund, and it was scheduled to be $500 million. They announced last week they closed at $700 million. And when you talk to some of their LPs, again, Carlyle says this is not an impact investment fund. That's how Carlyle looks at it. But when you talk to some of their LPs, like me, they're in it really for the impact.
Well, this raises such an interesting issue, because I guess I've talked to 3 fund managers in the last week or so who 2 years ago would have comfortably said we're impact investors, And now they say that if we use the word impact investing when we go to raise money, it's actually like we're taxing ourselves, because we're actually immediately inviting people who were open to investing in bottom of the pyramid strategies in sub-Saharan Africa or in Mexico or whatever. We're actually inviting them to say, oh, maybe you're not really serious about making money.
Yeah,
out of this.
we hear this from entrepreneurs
So
too.
is this label actually doing more harm than good?
Well, so I think one of the things we've talked about is if there's clear intent, if there's a commitment to measure and transparency, and if we could get to a certification with those three things, then we wouldn't have these debates anymore. But we do hear this from entrepreneurs too. But when you think about, let's just talk about transportation for a minute. When you think about entrepreneurs that have been unleashed in transportation, you have Taxi Magic, you have Lyft, you have, we were at a pitch competition at South by a few weeks ago, South by Southwest, and there was a guy who has an app called Ride Scout, and it lets you look at your phone and know from where you are every available mode of transportation to get you to where you are. So that kind of unleashed thinking differently about how to come at a problem is emerging. And some of those entrepreneurs want to be known as impact and some don't. And again, going back to the Carlyle example, they didn't have to say that they were impact, but LPs or investors can decide, I'm in this for this reason, and this is their intent, this is their measurement, and this is their transparency around it. It feels like we want to box everything in, but what we really need is comfort, measurement, and transparency for investors so they know what they're in for, and for the fund or the company you're invested in to commit to those things.
Matthew,
So,
if I could just on that one, without mentioning the name, I'll just say one of the early pioneers in the world of impact investing that really helped make the name impact investing now is shying away from it, in part because of the risk profile. People, they prefer calling themselves venture capital because venture capital has a certain amount of risk built into it, and they need risk-oriented capital. And when you're raising money for an impact investment fund, it sounds just way too philanthropic and more conservative.
Now, when we come to philanthropists, I noticed that Bill Gates has done a number of things where he has put in place a first loss guarantee for the fund. In order, I know Bloomberg has done the same with the first American social impact bond. Is that something where philanthropy could be doing a lot more in terms of stepping up?
No question. So even things like loan guarantees, et cetera, are tools that we've used, and they're just different ways basically to look at how to deploy your assets for good. And we actually partnered with the Gates Foundation around the area of bed nets, where we're trying to scale to eradicate malaria over a short period of time. And there was concern that the global fund money might not transfer fast enough for the path we were on. So we used private money to guarantee that it would be there if the global funds didn't come through. So the manufacturers could stay on schedule, so the bed nets could get out to communities without interrupting that flow. Turns out it wasn't needed. But the other point we sort of have touched on in the conversation, but not overtly, is this whole idea of almost democratization of investment, if you will. Because we talked about institutional, but one of the things we've done is we've fund platforms, technology platforms, that enable individuals to invest in things they care about. And largely the stuff we've done have been philanthropic investments, but we're seeing a scale there that I think bodes well for impact investing and the crowdfunding opportunities there. So we invested about $4 million in different ways, some for profit, some not for profit, in 3 platforms. One of them alone last month announced that they're over $1 billion in microdonation giving, just one of the platforms. The others combined are about at $500 million. So that was $4 million unleashed to create about $1.5 billion in giving. Think about Kickstarter. Kickstarter funds more of the arts than the National Endowment of the Arts. So we're in a new world where technology is enabling people to say, what do I care about and what are my on-ramps to basically invest in stuff in new ways? We're not totally there from an institutional standpoint yet with impact investing, but crowdfunding and some of the new technologies are really enabling people to get engaged.
So what needs to happen for this to move to the level where there's investment opportunities in people's 401k plans that are impact, that you're seeing big sovereign funds putting money into
Yeah,
impact?
well,
I mean, how
we
far?
are-
What needs to happen to start changing
There's
the
definitely
landscape in that way?
a very, very activist, I mean, Tracy talked about it earlier, there's an activist group working with the banks, working with the institutions, going anywhere that they can and talking about impact investing where, the financial crowd is gathered, if you will. And I really do feel traction. As I said before, it is still early days, but I am really feeling that traction. But, just having the conversation around would you consider, it's really quite surprising to me how people will. And they'll start, making it part of at least a topic, and then if it's a topic, it'll become an action. And we're doing that across the board. Michael,
do you want to come in on this?
Yes, I don't think I don't think any of our investments should be in anyone's 401k. I honestly, I think what we do, again, financial services for the poor, highly risky. I do think we can grow, and
Would
it
you
will
say
take
that
a long
Facebook
time.
should be in anyone's 401k?
Well, that's a different.
I don't know. I mean, why are you saying that this risk in developing countries at the bottom of the pyramid is a bigger risk than buying some of this crap that's being sold by Silicon Valley?
There you go. There you go. No, I
No,
do
really,
think
it's a serious question.
No. I got you. Look, I'm not going to comment on Facebook, but
I'm not saying they're crap, obviously, but
Oh, I thought you did actually.
Well, no, maybe overpriced. Maybe overpriced.
No,
but,
I mean, we're working these are risky investments. I do think we're learning a lot. I do think there are potential for very significant returns. I think we're a long way off from it being at the stage where someone could check a box on a 401k. And again, I'm not sure that I really see that as the end game. I do think that there are very significant opportunities to realize strong market rate financial returns and have enormous social impact. Especially, I should just say, one thing is, we were talking about trade-offs before. At least in the world of financial services for the poor, I'm not sure I see a trade-off at all. Most of the companies that we're investing in, they may fail, but if they don't fail, they're likely to have an enormous social impact and a very significant rate of return.
I was just going to say, Matthew, that a lot of these vehicles won't be available in the 401k for some time just because of the risk profile. However, that said, there are several examples where it's attracted retail customers. One is the Calvert notes. The other is the IFM bonds, the vaccination bonds, and Alex Friedman is here. When Alex was at Gates, he was the person responsible for getting the Gates Foundation to move into PRIs and deploy up to $1 billion of their balance sheet toward these purposes, and those have been very successful retail instruments. But until we get the business case right and make sure that the risk mitigation strategies are in place, we still have a lot of money to be deployed outside of reaching into the retail pockets.
Matthew, I'll add to sort of 2 points. I think one is to your point about tiered capital structures. We're starting to see that in industry, and I think it's a very, very important progress, I guess. We have a deal in Africa called MCOPA. Some of you might be familiar with that, where we invested in sort of low-cost solar home systems powered through the pay-as-you-go system in mobile technology. A couple of months ago, it just closed on $20 million. It's a $20 million round, which will power over 1 million homes in Nairobi in Kenya. And in that particular deal, Bill and Melinda Gates Foundation social investors came in but in parallel with that, African commercial banks also came in. Right, so it was a tiered structure, similar to what I'm talking about. We're starting to see that in industry. The second thing I will say about sort of one way to get this sort of market sort of into fruition is if you look at India, the Indian government just put at a policy level a 2% CSR, compulsory CSR rule. And that's quite an interesting thing to watch, where now all corporates in India are committed or compulsory have to apply 2% of their profits into the CSR space. And something as powerful as that at a government or policy level could really sort of suddenly incentivize the space, because now people are looking from non-profits, traditional grants, all the way to impact investing. So there are changes happening, and this just is some of the things that could happen or should happen.
Great. I mean, I think we're getting pretty close to time being up, but I wanted to ask each of you, as you finish, to basically first of all say, if anyone's more interested to know more about what you're doing, how can they find out about what you're doing? But then secondly, if you could look forward and just say, here's the most exciting investment opportunity which is going to generate positive returns that you can see out there? It may be a specific investment, or it may be a category of investment that you think this is going to be a hot area for the next couple of years for someone who is approaching their investment through this dual perspective of wanting to achieve financial return and make a positive contribution to the world. Let's start with you, Anne.
Let me just whip up my crystal ball.
Those
No,
are
but I
helpful.
think in Asia, I think different sectors, different countries all have different value propositions. In Asia, we see a lot of particular growth in education. Obviously, that's one of the largest philanthropic sectors that's driving that. So, energy.
Do you see for-profit education? Or?
We do see a lot of, particularly in the case of India and Philippines, we see a lot of interesting vocational models, particularly in that segment. So vocational models in education is very powerful. Clean energy, obviously, access to rural energy is a huge problem in Cambodia, in India, and so forth. So we see a lot of scale in these two industries.
And if people want to hear more about what you're doing?
In terms of finding out, well, please stay back afterwards to speak to me. We have our website as well that has all our stuff, so it's lgtvp.com. I would just close by saying one piece of advice, if I can. We've screened over 5,000 business plans over the last 7 years. And I would say ideas are cheap, business plans are slightly more expensive, but execution is priceless. So always focus on the execution. Because quite often you have impact investors talk about all these great ideas, great business plans, but at the end of the day, it's the ability to execute that really matters. So that's one of our key learnings over the last 7 years.
Michael, switch the other end.
So there are some big trends that are all coming together, one of which, of course, is mobile money, and people are figuring out how to use cell phones all around the world for payments, and you're seeing that in Kenya, but it's not only Kenya anymore, it's now Uganda and Tanzania and Bangladesh, and increase. So people are beginning to figure out how to do payments. The thing that I'm excited about beyond that is harnessing big data to go beyond just payments. With big data, you can start to know your customer in different ways. And I'll give you an example. There's a company called Tiaxa. It's a Chilean company that now is operating actually in 10 countries around the world. What they do, the holy grail of financial inclusion is how do you use these cell phones that are now 85% of the world have to do things beyond payments like lending and savings and insurance and the full array. And so this is one of the first companies in the world to begin lending over the phone. And we all use our phone and then get a bill after the fact. Almost the entire rest of the world prepays their cell phone, and when they run out of money, the calls drop. What Tiaxa does is based on how you have prepaid your cell phone, they at that moment in time will issue you credit. They don't call them microloans, they call them nano loans. And they get repaid 97% of the time, which is just like microfinance. So I said, how much can you know about someone purely from their prepaid cell phone history? Turns out they have 70 different fields of information. If you prepay every Monday, it's very different than if you prepay randomly. If you prepay a lot, it's different than a little. If you are texting, it says you're literate. If you are using 5 cell phone towers, it's different than if you're using 1 cell phone tower. If you're regularly communicating with 12 people, it's different than if you're regularly communicating with 3. So they can really build sophisticated profiles. And the key part there is then we can know our customer in a different way and design appropriate products for people living in poverty all around the world. So the combination of mobile phones and big data, I think, will really allow us to get to a financially inclusive world. Again, early days, but some really, really exciting opportunities out there.
Tracy? And they can find out about Axion.
www.axion.org.
Great.
You're so good, Matthew.
Yep.
I think we are living in really unprecedented times. I think both the income and wealth inequality is historic since the 1920s. And while, of course, some level of inequality is actually healthy and good for society, it spurs competition, a high degree of inequality is bad for economic growth. And I think we're living in an era where we're really thinking about new solutions that are much more shared and requires the participation and coordination of multiple sectors. These challenges are extremely complex. extremely shared, and so are the solutions. And of course, our work at Social Finance, which is www.socialfinanceus.org, is very much about working at the intersection of creating new public-private partnerships so that we can bring together the capital markets, the public sector, the social sector in a way that we can create economic value and deliver social impact at the same time.
And if you had to pick one example of something that you think, I mean, are there going to be a lot of social impact bonds coming to the market in the next few months?
Yeah, so globally there are over $100 million worth of deals active now, and just in the domestic United States market, an expert at the Kennedy School estimated that we're going to see $300 to $500 million worth of deals coming online in the next 18 months. So it's really pivotal point in the very nascent industry's history.
And Jean, I want to ask you one more question before giving you your final,
Okay.
which is that obviously you've been very involved with the Giving Pledge billionaires in trying to figure out how you as a group can collectively use
right.
your money to accelerate this field.
That's right.
What can we expect from you in the next year or two?
For those of you that don't know the Giving Pledge is made up of high net worth individuals who've committed half or more of their capital to doing good, basically, to philanthropy. And what we've done there is we have something called a learning series, and really the most vibrant sort of channels within that is impact investing. And so we're spending a lot of time comparing notes, trying to educate and inspire one another in this space. And I think the potential represented there is quite great. But I've tried to also make clear today, we're working at every level to try to do that, at least as a foundation with many partners as well.
But do you think you might get a group of you to come forward and sort of create a fund around this or something of that kind?
Yeah, I wouldn't want to speak for my colleagues in the Giving Pledge. I will say I'm hugely encouraged and excited about the potential there. Yeah, I do.
Okay.
To your question about sort of what's it going to look like, what are the new things we'll see coming, you know, one of my favorite quotes is Henry Ford, who said, if I'd asked people what they wanted, they would have told me faster horses. And the idea is that you can't always see around the corner. You can't always see what's next. And if we've learned anything in the last 10, 20, 30 years, sometimes it's really hard to predict what's going to emerge here. And I think some of that is going to play out in this space. You know, I was sitting with a high net worth team from one of the big banks and said, okay, so here's my question. I can give you a negative screen for a portfolio, and you know exactly what to do with that. You know what's out. But what if I say, I care deeply about these areas of impact? Do you have a product or a structure that can sort of channel my investments within asset classes accordingly and tee up opportunities? So, I mean, I think there are really basic things we can see built that we can see today, and then I'm hoping all kinds of new radical. When I say radical, I'm not talking about the risk, I'm talking about the approach. Certainly if somebody could come up with Bitcoin and cryptocurrencies, can't we find all kinds of new ways to think about using capital for good? And so I'm excited to see what's going to happen. And in terms of where we are, and it's actually, if I can be bold enough to close with an ask for this audience, we have put out for basic crowdsourced response a short guide to impact investing. And the reason we committed ourselves to this work, Sean Green is with us, and he is affiliated with us as executive in residence. And Sean was chief of innovation and investments at SBA, and he played a huge role in bringing this short guide together. We thought it was a tool that's really needed because there are a lot of questions and confusions around this space. You can find it at casefoundation.org, and I would invite any comment, any feedback. We really are putting it out there for a comment period before we close it and call it the real guide. And I can't think of more qualified folks than some of the people gathered in this room.
So that's casefoundation.org. And you are Social Finance?
US.org.
US.org. As I say, there will be the National Committee report for the US coming out soon on the Impact Investment Task Force. The main global task force report will be in September. Do look out for that. I mean, I think, in closing, it does seem to me that, every investment is an impact investment, whether you like it or not. And I think everyone as an investor has a sort of moral responsibility to think through what impact their money is having on society and the environment. And what excites me so much about the potential of this field is that, as you say, all sorts of new tools and screens and ways that we can actually fulfill that moral responsibility are being created, and it will hopefully over the next few years, if we can take this seriously and this work, build on this work that's going on, actually start to make it much easier for every investor to feel comfortable that their money that's making them richer is also making the world richer. And I think that is a goal that we really need to embrace, particularly at a time when people are getting more and more worried about inequality and a way that maybe capitalism is going the wrong way. So I'd like to thank the panel for really very thoughtful comments. Thank you very much.